All right, everyone. Thank you for tuning in. Today we have an exciting call for you where we will be covering our ETH partnership with Gamma Strategies. Gamma Strategies is a Uniswap v3 sort of add-on that allows for some interesting strategies. Today we have joining us is BP, the co-founder of Gamma Strategies.
Hey Jasper, thanks for having me on and glad to be here.
Great to have you. Can you tell us a little bit broadly about what is Gamma Strategies?
Yeah, absolutely. So Gamma Strategies, we're an active liquidity manager on Uniswap and other concentrated liquidity AMMs. And pretty much what we do is we create an ERC20 token representation of our managed Uniswap v3 positions. Uniswap v3, if you're not aware, their LP positions are represented by NFTs because each
Hmm.
position is technically unique, where people are deciding to provide liquidity within certain liquidity bands, and because they have a need to express like the uniqueness of each liquidity position, their positions are represented by NFTs. What we do is because anybody that provides with Gamma is essentially providing in accordance with our managed strategies, we're able to create ERC20 fungible liquidity tokens. And those liquidity tokens can be staked for additional rewards, like either RPL rewards, or they can alternatively be collateralized in a lending contract, and you could borrow against those positions as well. So we've been live for approximately I would say May of 2021 is when we officially went live, and we've been managing various pairs on behalf of different protocols since that time. And I guess just by way of background, the we had a proposal for Rocket Pool back a few months ago, illustrating what our strategy would be for the rETH pair. And based on our backtesting results, then we had decided upon that our strategy would be this: we would manage the liquidity ranges plus or minus 1.5%, not of the market price for rETH, but in accordance with the NAV or the net asset price of rETH. And what we do and how our strategy works in the background is it pulls the net asset value by querying the rETH contract. And if you go to the rETH contract and you read the contract and you look at what the exchange rate is, that is essentially what one rETH is supposed to be worth. Now, obviously, it's been trading at a premium. In the past, it's been trading at a discount. But in the long run, we think the price should approximately equal the net asset value. And with Uniswap v3, the more that you can accurately somehow predict the price, the better your LP performance will be. Now,
Let's
so yeah, go ahead.
Yeah, let's dive in a little bit on that concept, just in case people who are listening in aren't so
Sure.
familiar with this idea of concentrated liquidity. So we have this idea of what rETH is supposed to be valued at over time, and it's essentially a formula that tracks linearly over time with rewards. Uh,
Right.
and as liquidity provider managers, we should be able to take advantage of that knowledge with this idea that we know the approximate path of the value, the asset value should take. Concentrated liquidity sort of enables that. Concentrated liquidity, instead of a full range liquidity like Uniswap
Right.
V2, which would allow you to trade essentially, which would allow you to process trades no matter how much volume is coming in. Sort
Right.
of concentrated liquidity sets distinct bands in which trading can happen. So, what are
Right.
some pros and cons about this concentrated liquidity?
Yeah, so I would say the biggest pro is the capital efficiency of Uniswap. So as you mentioned before, with Uniswap V2, you're providing liquidity over the entire price range. So if you were managing rETH over a full range, you're essentially providing rETH when it's trading at a price of 0 ETH to a price of infinity ETH, and uniformly across the entire price band. So for a very well pegged pair like rETH is technically supposed to creep up on the value of ETH over time. Right now it's around 1.05, but it's going to go up 1.0501, 1.0502, and it's going to go up over time. And by having that knowledge, we can concentrate the liquidity, and instead of having the liquidity go, across the entire range, we concentrate it in a very tight range. And by having more liquidity within a tighter range, you can support more volume with less price impact than the same amount of liquidity over a larger range. So
In
that
other,
would be, yeah,
in other words,
go ahead.
we're greatly increasing the capital efficiency. The amount of liquidity that's being active or being actively
Mm-hmm.
used should theoretically be going up a lot. So we're cutting out all this inefficient liquidity range.
Yes, exactly. That's correct. And there are other types of concentrated liquidity AMMs out there. I would say Uniswap is one of the only ones where you can exactly pinpoint where you want the liquidity to be. I think with Balancer, you could somehow get to the same answer by choosing uh, certain points where you want it to be pegged. And so even with Balancer, even though they are providing liquidity over the entire range, because you have an amplification factor where the peg price should be, most of the liquidity will be on peg, but they will still provide for liquidity off peg. So I guess one of the downsides to Uniswap liquidity is, despite being a lot more capital efficient, it if the price were to go out of range, there necessarily wouldn't be liquidity in the Uniswap pool that will get you back from, the off peg price back into your liquidity range. However, it does work to your advantage that, you do have liquidity pools on Curve, you do have liquidity pools on Balancer. So if the price were to go off of peg, uh, there's ample liquidity in other sources to arb the price back to the peg price without having to go through the Uniswap pool. In fact, perhaps having less liquidity between, where the current premium price is and where the peg price is, could allow it to more easily maintain peg, because the less liquidity you have there, the more the trades that are being made. For example, if people are selling rETH into the pool, the more price impact you'll have in getting the price of rETH back down to what its net asset value should be.
That's awesome. Let's break down some of the concepts there. So what you're
Mm-hmm.
describing is how one of the cons of concentrated, or quote unquote cons of concentrated liquidity, is that if the price deviates outside liquidity bounds, well, all the capital that's been supplied there is now sort of moot for carrying out transactions, and then trades will get more slippage. However, what you suggest is that can sometimes be beneficial in the case of a large premium or a large discount. It's somewhat
Right.
in the protocol's interest to push people back towards native asset value. I mean, ideally, we would have the native asset value be one to one perfectly with the market value,
Right.
and the incentive management committee, is even reducing incentives to try to nudge the market back towards that direction.
Right.
And what actually, there's a real world example of when concentrated liquidity can make this more challenging. In the great Lido DPEG of May 2022, sorry, May
Mm-hmm.
2021, when Three Arrows Capital, everything went back down. Oh, that was later
Right.
this year. Sorry, so much happens in
Yeah.
crypto. It's impossible to tell when
Right. Right.
things are. But when that happened, when Steve depegged, there was a ton of capital in the Curve pool,
Right.
and they tried to fix it by launching a new pool, a concentrated version, uh, around the DPEG. But what ended up happening is they just increased the amount of liquidity at this far out point, and now more
Right.
trades had to be done to push the price back to the actual native asset value.
Right. Exactly. And I think there's a lot of external factors at play here, why it trades at a discount, why it trades at a premium. I think, in your case that you referenced with Steve, there was just a lot of dumping of stETH on the markets, due to 3AC and other external factors, which caused it to depeg and cause other staked ETH wrap tokens to also depeg. But you kind of see the opposite problem now with, like, the whole FTX collapse, and then there was I mean, I guess this is just a theory, but there was a lot of FUD against anything that's centralized. So you see, whereas Rocket Pool, I think the general consensus is it's more decentralized than your average staked ETH provider. So you start to see the price of rETH to even go above peg, and it was made a little bit worse by there being so much demand
Hmm.
for rETH that there was not enough space, or there were not enough node operators to handle that demand. So people were buying it on the market instead. And I've been tracking this pool quite heavily, just the entire trade route, and there's been like 300 ETH purchases of rETH, like trading over 2% above peg. So there are parties out there that believed it was worthwhile to buy 300 ETH worth of rETH at over a 2% premium, which is kind of amazing, but it
Yeah.
didn't work out too well for our liquidity situation, because we were plus or minus 1.5% off the peg price. That's how much the upper range was going to, the upper and the lower range for that matter. But for a good part of that, it was out of range. So I sent a report, an analysis that we covered on this position, and also potentially going for a plus or minus 3% position. And I back tested this over a period of 6 months, where it was under peg, it was over peg, and I would say right now is sort of an anomalous moment in time where it really hasn't been this far above peg for this long of a time period. But if we kind of
That's right.
normalize this and look at a 6 month rear view look at the position, 1.5% actually did fairly well in terms of beating just holding the assets out of the position. According to this report, the total gross fee APR is around 4.23% in 6 months, and it beat holding the assets by around 1.5%. And this is
Wow.
despite, having a lot of the price even out of our range. And when it was briefly within our range, so we started this, I would say, like mid-November. And so it was within range for a week or two. And during that time, it was generating phenomenal volumes. It was on, I think there was around 2 to 3 million in TVL in the pool, and it was generating 2 to 3 million in volumes per day. And it was beating the balancer pool, which, I think there was around 50 million in the balancer pool, and it was consistently beating the balancer pool when it was in range. But of course, when it went out of range, there's a lot less liquidity. Although some external liquidity providers have provided off peg liquidity, which is a good or bad thing, but it wasn't enough liquidity to support the massive amount of volumes that currently go through the balancer pool. So, but the case, I guess the shining light that you could kind of take away from this is, if we take a long-term view of the liquidity position, 1.5% does fairly well, and we can rerun our optimization scripts every so often to make sure that that is the ideal range to provide in. And with Rocket Pool, I know that there are certain things that are on the pipeline. For example, the mini pools coming out
Hmm.
should
Hmm.
increase the number of node operators, and um, it should more cater to the demand for rETH, so it should trade more or less according to peg. And I would say the biggest thing would probably be like next year with the Shanghai update. I think
That's right.
they determined that they can now have ETH withdrawals. So once you have the withdrawals in place, and it's no longer a one-way bridge, you'll probably see very tight pegs to their net asset value. So I think right now, if you just analyze our program for the 4 week program that it was, and the majority of that 4 week program, it was out of range. It doesn't really give you the complete picture of the benefits of Uniswap liquidity, because for the majority of it, we kind of saw the cons of not being in range due to sort of this anomalous situation. But with the new updates coming in, with the Shanghai update coming later, I think we'll start to see the Uniswap position do fairly well, and with just a fraction of the liquidity that's in other venues. So maybe I'll take a
Yeah.
breath
Yeah.
there and answer
Yeah.
some
There's a
questions.
lot there to unpack there. Great answers. Great information. So let's perhaps start with this 1.48% uh,
Yeah.
sort of value add over the base rate. So I'm curious, when you did this calculation, did you account for the changing amounts of rETH being held, or is it sort of just totally indifferent to the assets and just measuring the value over time, regardless of the composition?
Right. So it compares the value of the LP position to the original. So we assumed a 50-50 position to start with both rETH
Hmm.
and ETH. So assuming that we didn't LP those assets and we just held, half of the position in rETH and half the position in ETH, how well did the liquidity position do relative to just 50-50 hold? And perhaps it's even underestimating the total return, because right now it assumes that it's valuing rETH at the premium amount. So that's why you see a pretty big variance between the gross fee APR and impermanent loss, or the metric, the LP versus HODL. Like it should,
Hmm.
like theoretically, it should be closer to the 4.23%. But because rETH is at such a high premium right now, the HODL metric is being a little bit overstated if you were
Right,
valuing rETH at its current market price.
right. I mean, if you bought rETH at the start of this back test, you were buying it under peg and can currently sell it over peg.
Right.
So that alone gives you the profit.
Right. So it could very much be understated at the moment. Um, And also, for a lot of this period in time, it was out of range. So if it were more in range, you would probably see higher profitability there. And I kind of gave an optimization run. I also ran a few more this morning. If you look at in the report that I sent, if you look at the
Hmm.
very end in the appendix, you can see like I ran an optimization script that shows, based on a variety of ranges and rebalance triggers, what the impermanent loss and gross fee APR are. So there, it found a few different metrics which got you, up to 1.83% outperformance of holding the assets, and around 4.8%. So I just made this last night, this report,
Hmm.
and then this morning I reran the optimization and I got some better metrics. But for more or less, it's about the same, around plus or minus 1.5%, with around a 10% rebalance trigger. So a rebalance trigger means, if we set it at 10%, that means where it is at the current price, if it moves 10% of the way through to the upper end or to the lower end, it'll trigger a rebalance. And what triggers the rebalance is not the market price, but it's the actual net asset value. So only when the net asset value goes 10% of the way through our range, will it trigger a rebalance. So given that it's, plus or minus 1.5%, just take 10% of 1.5%, that's 0.15%. So if the price moves 0.15% up, or if the net asset value moves 0.15% up, it'll trigger the rebalance where everything gets pushed up 0.15%, if that makes sense.
Yeah, yeah, that makes sense. It's also very convenient from a management point of view because you're not sort of beholden to the market and oracles. You can just rely on the native Rockypool smart contract, and it sort of
Right.
makes liquidity safer in that regards. And that's another topic I want to talk about. How yield, quote unquote, yield farming differs from people seeking out yield from rETH on Uniswap v3. It's almost a fundamentally different kind of yield. So of course you can yield farm with Gamma. We did an
Mm-hmm.
RPL liquidity mining program.
Mm-hmm.
However, as you suggest, there is some inherent ETH value that you get that is unlocked, that
Right.
is sort of truly unique to Uniswap v3. And part of that, or a large part of that, is because of what you mentioned, in that the amount of liquidity within Uniswap v3 positions is tiny compared to Balancer or other full range positions, but the volumes that they get are fairly similar. Right now, despite being out of the range of this program, despite being over pegged by 2%, a
Mm-hmm.
huge amount of volume for RE is on Uniswap. It's sort
Yeah.
of just like the beast of Uniswap, how powerful it is and how dominant it is in the ecosystem. No
Right.
matter where the actual liquidity is, Uniswap is still going to get demand. So there are huge amounts of benefits to having liquidity on Uniswap.
Right. Yeah, I completely agree with that. I think I did a research study with the Uniswap Foundation a couple months back, and we were looking at just some of the numbers. How much liquidity gets directed to Uniswap via DEX aggregators versus just total volume in general. And when you just look at the DEX aggregator market share is probably like the most unbiased look that you can get for what's the trade volume market share of all these dexes like Curve, Uniswap, Balancer. And Uniswap, I think, had around like 50 to 60% overall DEX market share on DEX aggregators. But when you just
Hmm.
look at overall volume, they had between 70 to 80% overall
Wow.
market share.
Wow.
So, you know, they get a lot of retail volume. People just naturally just go to Uniswap and just make swaps just by default. And maybe this is just a sign of how early we are, and as people get more educated, they'll start going on to DEX aggregators. But they've kind of had this variance and this lead for quite some time. So I guess the main takeaway there is, although you may see that trade volume market share for Uniswap dwindle over time, there still is a material amount of just retail volume that they get in the pool, which is a good thing, and it certainly helps to have a presence on Uniswap, as it will certainly get more volume than without being on Uniswap.
Retail volume is actually a very important driver to making LPs profitable on Uniswap. There was an
Mm-hmm.
analysis done a few weeks ago that sort of looked at toxic flow and how much it dominates certain Uniswap positions. And the ETH USDC pool, I believe, was the least
Yeah.
toxic, meaning it had the most amount of natural retail volume. Uh,
Right.
and that's good for Rocket Pool because it's likely that if ETH has the most non-toxic flow, that liquid stake derivatives, which really inherit a lot of the properties of the underlying ETH asset, stand to
Mm-hmm.
also have a lot of non-toxic flow. And if that is the case, well, then Uniswap is going to be the best way to tap into that retail flow.
Right. Right. And I think also with a lot of LPing on Uniswap in general, like a lot of people have kind of fudded it a little bit because they're mainly because they don't understand how it works, but also because there's potential for a lot of impermanent loss
Mm-hmm.
on extremely volatile assets. So, when I tell people LPing, people ask all the time, is LPing on Uniswap profitable? Well, the answer is it depends. You really need three main things to be profitable. You need your two assets to have a very high correlation. You need high volume and incentives, if possible. Typically, with just two out of the three of those things, you can be pretty profitable. I mean, this isn't like a law, but it's just sort of like a guiding principles. You just
could you
Yeah.
could you describe to me through this example why that's important? For example, why is it likely that an rETH pool would outperform for most users
Mhm.
trying to do just
Like
normal
ETH
ETH
USDC,
USDC? Right. Can you just
right?
elaborate a bit on why that ends up playing out?
Yeah, sure. So the main reason is due to the price divergence in the pool. So when one asset increases against the other asset, as the LP, you're the one that's selling the other asset. So if let's say there's a lot of demand for ETH in your concentrated liquidity position, you're going to be selling off the ETH in your pool for USDC. So the tighter your range is, the more quickly you're converting the ETH in your pool to USDC. So, and ETH is the asset that is rising. So you have less of the asset that is rising, and you have more of the asset that's that's being used to purchase that ETH. So while ETH is rising in price, your liquidity position is getting more and more devoid of the better performing asset. You have more of the underperforming asset, which is USDC, and that is the cause of the impermanent loss.
Right.
But
And this can be
in
huge swings, right?
exactly, and so in order to mitigate that impermanent loss with ETH USDC, we go a lot wider for the ETH USDC position because oftentimes, I mean, we ran a year back test on ETH USDC, and this period covered the FTX collapse, the 3AC collapse, the Luna collapse. So it was an extremely volatile period, and we chose a range of 10% to 1,000%.
Wow.
And based on our backtesting results, that was the best parameters, assuming we're not like trying to narrow our ranges during low volatility and increase our ranges during wide volatility. I mean, that's, I think, the ultimate goal, but you almost have to be able to predict prices extremely well. I mean, we had a lot of trial and error with these more volatile asset pairs where we tried going narrower during times of low volatility, and we tried going extremely wide during wide volatility to try to, take advantage of both types of environments. But the impermanent loss that you can suffer, let's say if you have a very tight range and then the position were to go out of your range, or the position were to get extremely volatile, the impermanent loss that you suffer often isn't enough to make up for the fees that you're generating from having a tighter position. So while you are generating more fees for your position, the permanent loss that you're suffering is greater when you have a tighter range. And just to kind of illustrate this, if you think about what a 1% impermanent loss means, it doesn't sound that much on paper, 1% impermanent loss, but to think about how many fees are needed to offset that 1% loss for an entire day straight, you need 365% APR to make up for 1% of impermanent loss. So that just kind of shows you, maybe gives you a sense of, how dangerous impermanent loss can be, and how much additional fee revenue you need to make up for that. And luckily for rETH, you could get extremely tight ranges, like plus or minus 1.5% versus 10% of the current price and 1,000% of the current price that we use for USDC ETH.
Right, right.
So I mean, that's why the rETH ETH pair, it's an extremely good pair to LP, and I think it just needs a little bit of liquidity in there, and I think it doesn't need a lot of liquidity. It should be able to generate natural liquidity once, once the price maybe comes back more down to net asset value. Like the volumes will start to pay dividends, although it's not very obvious right now, given that it is out of range.
Yeah, I mean, I fully agree there. The way the concentrated liquidity works for rETH, it'll end up being the better long-term play for a lot of retail volume, especially post withdrawals, which you mentioned
Yeah,
previous. So withdrawals is going to make things very interesting for the LSD marketplace. Uh,
right.
there's a lot of theorizing about how things will play out, but certain things are for sure. One, you will finally, for most LSD assets, be able to burn and redeem at the native asset value. So for most assets, this means that the arbitrage loop can be completed. Uh,
Right.
what this hopefully means is that the relatively tight spreads that we see on LSD assets are ETH generally staying within 1.5%. Currently sitting at, I think, 2.3% above NAV. But
Mm-hmm.
these relatively small spreads should tighten significantly. Can you describe what we might see in Uniswap E3
Yeah.
positions post withdrawals?
I think post withdrawals, we'd probably tighten our position, and likely a lot of others would tighten their position as well. Um, one of the things why active management may make sense is because we can automate the rebalancing of these positions. And whereas, if you were providing this yourself, you'd have to continuously rebalance those positions, which could be more of a pain. But yeah, I think, just to answer your question, I think once the withdrawals come into effect, uh, the trade, the peg to its net asset value should probably be very, very close to what its net asset value should be. And I think once we reach that point, we'd probably tighten our range quite a bit, and it depends on how many other people come into this liquidity position, but I would imagine that you're going to get pretty good fees to TVL ratio for quite some time before that eventually gets dwindled down. But having that yield get dwindled down isn't such a bad thing either, because it just means more people are providing deeper liquidity at the peg price.
That's right. And this will pay dividends for the rETH ecosystem at Broad, since this much deeper native asset value price means much safer integrations more broadly. Lending markets, for example, are very highly dependent on DEX liquidity and their ability to resist price manipulation. So post withdrawals, Uniswap v3, which is somewhat notoriously weak at preventing Oracle attacks, hopefully should be much better or much safer. Any comments
Right.
on how Oracle attacks relate to Uniswap v3?
Yeah, I think the biggest Oracle attacks that we've seen with Uni v3 positions was from Rari. With Rari Fuse, they use the Uniswap v3 TWAP Oracle as the main Oracle, and this was for pools with not much liquidity in them, and that's where it gets really, really dangerous. Is when you rely on the Uniswap v3 TWAP Oracle and there's not enough liquidity in the pool. So what somebody can do is they can take out a flash loan, manipulate the price of one of the two assets so that it's out of range, and then they could deposit that asset as collateral on Rari, and Rari will think they have a lot of collateral when they don't, because they just inflated the asset with a flash loan, and because it thinks that you have a lot of collateral, they could just drain the entire lending pool, all the assets that are available for borrowing. They could just borrow it and not pay back, and then dump it for ETH, go through Tornado or what have you. But that is mainly for pools where the Uniswap v3 TWAP Oracle is the main Oracle. I think Chainlink is probably, if you were to use a Chainlink Oracle for rETH,
Right.
that would prevent this from happening, because Chainlink queries multiple different dexes at the same time. And also, with more liquidity in this pool, you'll be able to have a more robust UniV3 Oracle. I mean, you don't necessarily have to use a UniV3 Oracle, but you can. I mean, I think there is a Chainlink Oracle for rETH, so I don't think
Not
that would
currently.
ever. Oh, there isn't. Okay.
No.
Yeah, I think the requirements, we need to generate like, I think
Certain
like
amount
two,
of
three
volume per
million
day. Yeah.
per day for like 30 days straight.
Which is
Um,
another benefit of a Uniswap partnership, since a large or essentially very disproportionate sum of volume comes to Uniswap. It's for us getting that Chainlink Oracle, it's going to pay dividends to incentivize liquidity there.
right, right, right. Um, yeah, so I think definitely like Euler Finance too. I don't know if you guys
Hmm.
heard of them, but they've done a lot of good work in analyzing the robustness of Uniswap v3 TWAP oracles. They have a simulator on how much it would cost to attack a Uniswap v3 oracle, and whether it's feasible to attack this, because there's many situations where it just costs too much to manipulate the price, where the amount of value that you can derive from it is probably not going to be worth it. So they kind of do a lot of good analysis there. But I would say probably Chainlink is, although Chainlink is very, very expensive. I've heard stories where it's like almost 200-300K a year to run a Chainlink Oracle. So it's very, very
Wow.
expensive, but it's very reliable. I mean, it's the gold standard in terms of reliableness. But I think Uniswap v3, once there's like a standard on, okay, how much liquidity do you need within how many ticks, and what's the cost to manipulate this oracle. I think once there's more knowledge and more literature on how to prevent these Uniswap v3 oracle attacks, I think they will Uniswap v3 TWAP oracles will become more prevalent. I just think there's a lot of the FUD that happened from Rari hacks didn't help, and there's a lot of people are just kind of turned off by it, and if they don't understand it, they probably should just stay away from it until they have a good understanding of what all the things that it takes to attack it, because it could get very, very dangerous. And people out there are extremely smart, and constantly there are people that are analyzing all the Rari fuse pools and seeing which liquidity pools are the easiest to attack, and that's pretty much exactly what happened.
if an oracle is vulnerable, it will be attacked. I actually just lost a little bit of funds in the Lodestar oracle attack a few days ago.
Ooh, sorry to hear
Yeah,
that.
no
Yeah,
worries. I mean, I knew it was an unaudited compound fork that was doing leverage
yeah,
GLP, so it was in some ways I was asking for it, but I
got
digress.
it.
Yeah, so the Uniswap v3 Oracle, as it is pretty unreliable. And so while rETH could be used right now theoretically on Euler finance, we don't know in marketing on it, and we don't direct people there because essentially you're just asking for your funds to be liquidated.
Right.
But this is something that the incentive committee is well aware of. And so as we prep for lending platforms to adopt us, we've made
Hmm.
sure to have a wide amount of V2 full range liquidity on several platforms. And
Right.
Uniswap sort of just is the way I viewed Uniswap is in a position similar to Curve from a protocol's perspective, where it is a form of concentrated liquidity that well, it's even more concentrated because Curve can still go full range, but it
Hmm.
holds a niche point where you're really just gunning for capital efficiency with this pool,
Right.
right? So if you're going to gun for capital efficiency, you might as well go all the way, which is in some ways what Uniswap v3 does.
Right.
But there are other Uniswap v3 liquidity managers. How does Gamma Strategies compare to them? For example, I believe
Hmm.
Arrakis
Arrakis,
and
yeah.
uh,
I think
X
there's maybe
Token.
X token. Right, right,
Yes.
right.
Yeah. So
Um, yeah.
yeah, just describe the ecosystem and what separates Gamma.
Sure. I would say for this particular strategy where we're aiming the liquidity at the NAV price, I don't know of any other liquidity provider that manages according to that. And Arrakis V1, I think it was their Gelato V1 contracts, they actually don't rebalance those positions. They just maintain a semi-wide range. I think they have the ability to rebalance those positions, but they choose not to. They choose to just create very wide ranges. But having said that, I know they're launching Arrakis V2, which hasn't been launched yet, and I just kind of read the white paper. I know they're going through, I think they had one audit. I think they're also going through their second audit where it involves just uh, keeping some amount of liquidity on the sidelines and then also rapidly adding liquidity, removing liquidity, and placing it in different spots with just a select amount of the liquidity. Um, it's
Very
still
active management.
right, right. It's very, very active. I remember I talked with Arrakis on a different Twitter space, and I kind of just was questioning them, like, is that how are you guys planning to do that for mainnet? Because I mean, we've had a lot of trial and error on mainnet where we tried very rapid rebalancing strategies. There's a lot of risks inherent with rapid rebalancing too, because all our rebalances are sent through flash bots or some private RPC to prevent any sort of MEV opportunities. Um, but the
And also
more
every
you're,
time, every
yeah,
rebalance is sort of locking in IL. It's like IL is
exactly.
this theoretical loss, and it's only when you close a position that your loss is realized. I mean, any IL
Right,
position could be saved.
right, right. And I think they were trying to mitigate that by only using a portion of the assets in a very, very concentrated position and keeping most of the assets on the sidelines. I'm not exactly sure how that will perform. I guess if you have a few bad rebalances, it could be unprofitable over the long run. But that's really yet to be seen. I mean, I'm sure they're doing their own backtesting models as well. We typically don't like to rebalance too often because even if you are using, flash bots, a private RPC, even secure RPC, there's more lag time between getting that to completion than it is a normal transaction. Although it is um, although you're not you're not exposed to front running, but even then you still are. Like we've had some MEV opportunities arise even when we went through flash bots because
Oh yeah,
if
oh yeah.
yeah, if the transaction ends up in an uncle block is when two blocks are produced at the same time. Like even if you use flashbots and your transaction ends up in the block that doesn't end up in the main chain, there's like MEV searchers that just look at Uncle Blocks for MEV opportunities, and somebody did that to one of our rebalances and found
Wow.
yeah, I
I
mean that's
wonder
what
if
I'm saying. Yeah.
I've seen CowSwap transaction like CowSwap bundles
Yeah.
get the entire bundles get sandwiched, and I wonder if that's how that happened because I never understood. I've seen CowSwap sandwiched a few times now.
Yeah, yeah. I don't think it's like 100% like risk free. I think there's yeah, I mean the Uncle Block one is very, very like I think a unique situation. I think it's because we were doing so many rebalances, at least one of them had to have ended up in a Uncle Block. But yeah, so for the most part, like we try not to do too many rapid rebalances. I think with I think they also have another I think they have a deal going on with Lido Finance too, where they're managing wrap staked ETH USDC pair. However, I think right now in the beginning, I think it's better to go with like some wrapped ETH coin with paired with ETH because it's just a lot cheaper to source that liquidity because you could you don't need as much liquidity as you would need in like an rETH USDC pair. That's going to require a lot of liquidity, and if you're incentivizing rETH USDC, you have to necessarily go with a wider range,
Yeah,
certainly wider
absolutely.
than 1.5%. So it's incentivizing that liquidity is also more expensive because you need more of it um, to get the same amount of price impact that you have with rETH. And another thing that you would want to concentrate rETH first is because ETH USDC is a very capital efficient pair. There's a lot of liquidity for ETH to USDC.
One of the
So
most
by
liquid assets on Earth, honestly.
right, right. So if you had a very good rETH pair, you could very easily make the swap from rETH to USDC. It'll just go rETH to ETH with very low price impact and ETH to USDC with very low price impact. So I guess I would have suggested to them to go with Rapstate ETH or RE in your case rETH because it's the cheapest way to get a lot of liquidity and it'll get you quick. I mean, once you have a lot of liquidity, then you may want to start incentivizing rETH USDC and get an even better price impact. But I think if you're going like the just get the initial momentum first. I think rETH is probably the pair to start with first.
So what about, for example, X token? How
X
does
token.
Gamma, yeah, anything about or similar products or what
So
separates Gamma?
one thing different about X token. So one thing that was similar about Arrakis and Gamma is that we both mint ERC20 tokens that represent our LP positions. X token, they don't give you a receipt token for the liquidity position. I could be wrong, but last time I checked with them, they don't give you the receipt token. So that may have some downsides and just in terms of composability and being able to stake it for additional rewards. They have their own native staking, so you have to go through the X token front end. And I think for a while they just went with full range positions, but now they've also implemented tighter ranges. I don't know if they've gone through the depth of the back testing and the types of strategies. Like we have this active strategy framework too, where we manage two positions at any given time. If you look at our analysis, you'll see you see a base position and a limit position. You may be asking, what is a limit position? And basically, we try, and this is unique to the other active managers, with the exception of Charm Finance. So Charm is another active liquidity manager that uses a similar framework to us, but not quite. Essentially, when you're rebalancing into a different liquidity range, that new liquidity range is going to mandate a different allocation of assets. So what our active strategy framework does, it'll shove as many assets as possible within the new range, but because the new range is going to dictate a different allocation of assets, you're always going to have one asset left over, whether it's rETH or ETH. And so so whatever asset is left over is just pretty much placed in a limit position. And we don't conduct any swaps to get into position because that incurs the swap fee on the trade and it also incurs the price impact. And so based on our backtesting results, it was better not to swap, but to place a limit position And there's pros and cons to that. If so, it's an overlapping limit position. So it's essentially around half the width of the overall base position. And the price has to move into the limit to actually start earning fees within that position. So when it's actually in the limit position, you're earning fees from both the limit position and the base position. The one downside, though, is if the position moves further away from the limit, you're only making fees from the base position and not the limit position. And that, I know that was a lot of information. Happy to clear any of
Yeah,
that
yeah.
up.
So the base
But
position is your standard Uniswap V3 pool with the plus or minus 1.5% range, correct?
that's correct. And so is the limit position. They're just two Uniswap positions that are being
Got it.
managed.
Got
Mm-hmm.
it. With slight overlap, but a bit of difference. Or
Exactly.
got
Exactly.
yep,
Well,
yep.
yeah, it would be one half of the entire, approximately one half of the entire base range would be the limit position. The base range always contains approximately 50-50 of both assets, and whatever asset is left over goes into the limit position. So that part of our active strategy framework is different from both Arrakis and X token, and that was purely based off our results when we were back testing these pairs, just consistently utilizing limit positions and not incurring swap fees and price impact was better for the LP position over the long run.
That makes sense, and it's sort of funny because if you really dig into Uniswap V3, you realize it's kind of just an options platform. So having
Yeah,
overlapping expiry options is just
right.
standard risk management. So it works out quite
Yeah,
beautifully.
yeah. I think there's this guy named Guillaume. He's like some professor that he's building an options protocol on Uniswap where I think it's called Panoptic, and essentially a single-sided range on Uniswap acts like a call option selling payoff. It mimics the same curve that you'll see when selling a call option. Um, so yeah, that's pretty interesting.
Great. So that's about a little bit about what separates Gamma from others. There's been a lot of technical discussion here. So if you wanted to be a solo Uniswap V3 liquidity manager, it's kind of like you have to be a quant firm. But most users of Rocket Pool of Gamma are not
Hmm.
quant firms. So can you just
Hmm.
describe a bit of like the actual UX of, say I am an rETH holder and I want to
Yeah,
participate in either this trial that just ended or a future
yeah.
program. What is that process like?
Sure. So what would happen is you would our position is going to mandate X% of our ETH and Y% of ETH. You would go into our front end, and then just very much like if you were providing liquidity on Balance or Curve or Uniswap, it'll ask you, okay, you to supply a certain allocation of those base assets. The user would deposit those base assets into our contracts, and then they would get the ERC20 receipt tokens in return. And then their assets would be deployed directly to Uniswap V3 in accordance with the strategies that we have set up, which is plus or minus 1.5% of the NAV price. Now, if they were to deposit now, most of the pool, in fact, all the pool is in ETH because we're out of range. So they would solely be depositing ETH into our pool, but as the price comes back down to peg, it'll slowly convert that ETH to our ETH, and whatever assets are composed of in our pool is the allocation that's going to be mandated for the user to deposit.
Great. So if I'm coming in with ETH or rETH, I should be fine. Just depends on the status of the pool.
Right, right. So you would deposit just the base assets into the pool. You'd get the ERC20 LP token, and then we have a staking contract where you deposit the LP tokens in the staking contract, and you could get the RPL rewards.
Perfect. So it's a fairly straightforward process and much better than having to try to figure out your liquidity bands yourself. Uh,
Right, right.
but but many Rocket Pool users are Rocket Pool users because they value decentralization and trust minimization.
Hmm.
Uh, are there any trust vectors that or additional trust vectors from using the
Hmm.
Gamma Strategies protocol?
Yeah, there are. I would say so. The part that are not trusted at all, like so, in terms of depositing, withdrawing, that's completely permissionless. You could deposit and get the LP tokens, or you get the LP tokens and redeem them for the base assets. That occurs at any given time. The one part that is a bit trusted is we don't have the ability to, take or withdraw any of the assets, but we do have the ability to um, rebalance the price ranges. So when it hits the rebalance trigger, it'll rebalance upwards. Now, this is probably the main difference between us and Charm Finance. So Charm, they do all their strategies are on chain, where if it hits it's within embedded within their contracts that once it hits like the reset trigger, it'll rebalance the position. I would say the one downside to that is because it's all on chain, it's more predictable. Although if you just went with our strategies, it could be predictable as well. But we can adjust on the fly in terms of the ranges. Okay, look, maybe 1.5% is too narrow, or maybe it's too wide. We could help adjust that on the fly. So that those are the positive sides. The negative sides, of course, is if we were malicious actors, there's ways that you can um, extract value from range management. For example, you could move the liquidity way lower, create a lot of price impact, or buy it at a cheaper price. Um, the existence of other liquidity in the Uniswap pool helps mitigate against that, but there could be some value extraction potential there. What helps mitigate that risk is one, there's the external liquidity, but also number two is all our rebalance events they trigger all our rebalances trigger events completely on chain. So if there were anything wrong with the way we were managing liquidity, we would be held accountable for that, and it's pretty transparent the way we are managing liquidity. And anyone that goes onto our front end, if you go onto the analytics page, you can see exactly how the ranges have been managed. It's pulling directly from positions themselves. And if you read our LP tokens at any given time, you can get the exact range that we're providing in. So that helps sort of mitigate the risks and us being able to control the ranges. But that's I would say the extent of the sort of what we can control in terms of the admin controls. Everything else would be permissionless, including deposits, withdrawals, and things like that.
One of the benefits of the current backtested strategy uh, in fa in favor against I believe it was Charm or Iraqis, which
Mm-hmm.
use the very active model, is that it's very easy to verify that the management process is going accurately. As you said, uh, if you look at the pools, if they're not incrementing upwards in this 1.5% way based on the native asset value that updates at a very regular interval, it's very obvious that something's wrong.
Right.
Whereas if you are in one of the more active liquidity management strategies, it might not be clear right away that a hack is happening,
Mm-hmm.
which leads a bit into my follow-up question, which is what are the audits like for Gamma strategies?
Yeah, so we had a few audits. The latest one being by Consensus Diligence, who audited our latest contracts back in March of this year. That was a very intensive 4-week audit, um, and it was a very expensive audit too. But
That's for sure.
pretty much, I mean, Consensus Diligence, I would say, is one of the best in the business in terms of audits.
Mm-hmm. Rug
They're
also
very
uses them.
active with us. Yeah, yeah. In terms of like simulating potential attacks, they were the ones that came up with the TWAP check. So one of the things that we implemented after our last audit was we implemented two things. Number one is before we had allowed for single-sided deposits, now we enforce the ratio of the assets. That makes manipulation a lot harder. Also, we implemented a 30-second TWAP check. So if somebody were to manipulate the price of the assets, 30-second TWAP would likely differ from the spot price, and that would block off the deposits from entering into the position. They've also put, reentrancy safeguards pretty much at every corner of our contracts. We've also simulated potential attacks on this pool with and without the TWAP check. For the most part, even without the TWAP check, it's very difficult to get any material value extraction, although it is theoretically possible. But with the TWAP check in place, plus the mandating of the ratio of assets in the pool, that risk seems to have been fully mitigated. But of course, like I said, people are very, very smart. So that's why we also got multiple audits. We got another one from arbitrary execution, simultaneous with the one from consensus diligence. That was a less intense audit, but it still was pretty valuable. It was a 2 week audit. And then way before that, we had one from Certic. Would highly recommend not using Certic if you have one of your own protocols.
Might as well just not. Yeah.
Yeah. I mean, you kind of get what you pay for. It was significantly cheaper than our consensus diligence audit, but it was also way worse. I would say like the audits where you just kind of hand over your code base and they just look at it for a couple of weeks and send you back the report. That's probably a bad audit. Like the ones where it's really good is where from the get-go they're just interrogating you and just being really intense about asking you about your different contracts. And that's what consensus diligence did during our 4 week audit. In fact, it was supposed to be a 2 week audit, and then because we had so much back and forth, it ended up being a very intense 4 week audit, which we were in hindsight, I think that was a really good move, even though at the time we were a little bit disappointed because we thought we'd be done. But for us, safety of our positions is extremely important for us in order for us to scale and build out our TVL. So that's kind of the story with our audits. But we've had quite a few. We also have I think a small bug bounty too on Immunify.
Sweet. And that's also great to hear. Immunify bug bounties actually saved Rocket Pool once right before launch.
Oh,
Yeah.
nice. Was it
Day
with
of
Immunify?
yeah, yeah.
Oh, nice.
Day zero bug bounty critical error.
Wow, that's
Yeah.
amazing.
So never undersell security. And this
Yeah.
ecosystem is the single defining equality, arguably. Uh,
Right. 100%.
well, this has been a lovely call. Do you have any final thoughts on why Rocket Pool should continue its relationship with Gamma Strategies?
Yeah, sure. I would just encourage everyone to sort of take a long-term view here of I sent out the analysis which did a 6 month look back, but also going forward there's a lot of events that are upcoming that would likely more maintain the peg to its net asset value, or our ETH's peg to its net asset value, which includes the mini pools, which will increase the supply of node operators. And also the Shanghai update, where withdrawals are possible, will likely see a very tight peg to net asset value at that time. And what I'm personally looking forward to as well is there's a lot of structured products that are looking to be built. And perhaps this could be a discussion for another time, but there's a lot of structured products that are looking to build off of our ETH or other, liquid staked ETH products on Uniswap V3. And the main reason is the fees to TVL are a lot higher. And
Absolutely.
there's a way you can also do delta neutral liquidity providing. For example, if you're collateralizing a stable coin, let's say USDC, and then you borrow ETH on a lending platform, and then you supply that ETH to the rETH liquidity pool, that's pretty much going to be a delta neutral yield to the extent that the LP fees and the staking fees on the rETH side of the liquidity position, and potentially the RPL rewards, so long as all three of those outweigh the borrowing costs on that ETH, you're going to be providing delta neutral yields. And delta neutral meaning no matter which way the market goes for ETH, you're still earning yields. And the reason for that is because you borrowed ETH, you're only going to owe ETH going back. And if you look at the rETH pool, if you look at our optimization run, you can see for the vast majority of our positions, they were profitable. So you would have to just assess, okay, look at the impermanent loss metric, look at what the RPL rewards potentially could be, and look at what what the borrowing costs are. And if the LP fees, the RPL rewards is greater than the borrowing costs, then you're essentially making delta neutral yields on this pair. And with leverage, if you're able to then recursively stake your rETH and borrow more ETH against it, you can potentially get quite good returns with low risk of loss. I mean, it depends. You'd have to assess, uh, what the borrowing costs are, but you could potentially, and you'd have to manage your collateral effectively, but you could essentially get pretty good returns and predictable returns just because those pairs have a high fee to TVL ratio and they're very highly correlated. So the impermanent loss is much more predictable than, let's say, any other pair. So that's personally what I'm also excited about. But yeah, and perhaps we could discuss that another time. I know we're sort of ending up at the top of the hour. But having said that, it was a great pleasure to talk to you guys. And I know Uniswap V3 is very complicated for a lot of people, and there's a lot of FUD around Uniswap V3. But there's also a lot of ways to make money, especially if you have a pair that's very highly correlated that does generate a good amount of fees, which is the rETH pair.
I have to echo what you said. This has been a fantastic conversation. I'm just reading out a message here from the Pocket Pool Trading Discord chat that says, this is by Object Object. I'd love to listen to a 4-hour deep dive podcast with that Gamma guy, but I feel like Twitter Space is the wrong space for that. So we have the community has certainly appreciated you. I would love to have you back and maybe do a deep dive on how withdrawals are really going to shake things up for DeFi as it relates to the LSD markets. What you just said, this
Yeah,
sort of reciprocal relationship between lending rates and the ETH staking rate, I think it's going
right.
to essentially determine bull and bear markets in the future.
Yeah,
Uh,
absolutely.
but yeah, so we talked about a lot today. Gamma Strategies is an active manager of Uniswap liquidity. Rocket Pool just concluded a trial run with them, and you can find the results of this in the Rocket Pool Discord under the rETH incentives channel. We talked about how concentrated liquidity has incredible capital efficiency potential to help the protocol grow, and in some ways is a much more safe way to chase yield compared to yield farming and other avenues in DeFi. Uh, we talked a little bit about the retrospective analysis that you put together and how it demonstrates some pretty impressive yields on top of the base rETH yield. And we even talked a little bit about the potential future of the protocol when, after withdrawals, we could maybe see some turbocharged efficiency. Some great and exciting stuff. Thank you for being here.
Yeah, thank you. And that was a great summary. Thank you for having me.
Yep. All right. You can find this call recorded here and on the Rocket Pool YouTube channel. Nick, is there any more topics we want to cover, or?
Yeah, I might just jump in quickly and
Yeah,
go over a few protocol updates. Won't take too long,
let's
but
do it.
obviously have to start out by echoing your comments, Jasper. Incredibly interesting hour and a bit. So yeah, I think
I
it
hope
was
we
a
didn't lose
great
too many
call.
people.
I, for one, would definitely be happier to hear a longer call at some point. I think for me, having one of these positions and providing liquidity, not financial advice, it really helped to kind of inform what exactly it is that I'm doing. Right? Sure, you're supposed to maybe do a little bit more research to start out with, but yeah, great to hear. And I think maybe some interesting parallels between V3 and LEBs, right, in terms of the
Yeah.
trend of capital efficiency within the industry. And certainly for rETH, it just seems to me to be a no-brainer, right? I won't go over everything that was discussed. There's reasons why were outlined very clearly, I thought. But yeah, fascinating topic. and also have to agree on the audit side of things. Although I'm not personally involved, I do see a bit of the back and forth, and actually why Lang is not on this call today. The guys are busy running testing and getting stuck in with some of the initial audit reports that have come back. As a reminder, this is going to continue into the new year. So still a bit of work to be done, but certainly making progress on the Atlas protocol upgrade audits. I've got four or 5 points to run through pretty quickly. Shouldn't take too long. And it's essentially just recapping some of the stuff that's been mentioned in the Discord already. So not really too much in the way of new updates, but certainly things that I think people should be aware if they somehow missed the pings over the past day or so. First of all is the future calls for the rest of the year are all loaded into the Discord events channel. So our Twitter spaces are continuing through weekly, and it's just the Friday, well, at least Friday down here, chit chats where we have one more in 2 days' time, and then we'll probably pause that until the new year. I think just based on the turnout for the Thanksgiving adjacent chit chat, which was quite low, probably makes sense to have the Christmas and New Year adjacent chit chats also paused. But if there's people hanging around and trading around that time, we can always jump on the voice chat and do it a little bit more informally. Second thing is the Git POAP announcement. I didn't tag everyone. I thought about doing that, but we have a list of recipients in the protocol announcements channel. So go and have a bit of a look and a read of that. I will be following up maybe in a week or so directly with those who haven't DM'd me directly, but it would be helpful if you could go ahead and have a read, and if your name's on the list, flick me your details.
This is going to be my first Git POAP. I'm actually pretty excited.
Nice. I think the purpose of this one is to reward the contributions, which can be extremely valuable but may not be reflected in GitHub. So probably worth saying again, if your name is not on the list, there's a very good chance that I haven't been able to read every single comment about Atlas going back however many months these discussions have been going on. So yeah, if you think you're eligible, the bar is very low. Any kind of contribution or discussion would make you qualify. Just ideally flick me kind of a link to where that took place in Discord or the DAO forum or Twitter or wherever it may be, and we can get you added to the list, no problem. Then, speaking of the DAO forum, actually, we have a very important post by Joe, which went up almost 24 hours ago. It's called Proposal for Rewards Tree Spec V3, and it's something that affects it probably affects you, so it's worth a read, and it's certainly something that is, I suppose, a change to a rather fundamental aspect of the protocol. So it's good to see that there's been a lot of discussion already. I think 18 or so messages in the almost day that it's been up there. But yeah, more discussion is always better than less discussion. So even if your comment is that you agree or disagree with what's up there, please share your views on the DAO governance forum. Then
I was just going to say that this topic might at first seem very intuitive, given we already do our smoothing pool earnings based on performance. However, users did sign up with the expectation that RPL rewards were going to be given regardless of performance, so it's not quite as simple as it may be. So definitely encourage people to make their opinions heard if they feel like they are getting gypped or not.
Absolutely. And then ETH Denver. So there is a quote unquote official Google form that can be found in the same location, the protocol announcements channel in Discord. Please take the time to fill that out if you're attending or thinking of attending. It looks like we'll have some, we have got some decent expressions of interest for volunteering already. It'd be great to catch up with everyone there. It's looking like we're going to be planning 2 kind of off-site side events. The first one being more focused on socializing. Sounds like we might be booking out some bowling lanes and other activities to be confirmed. The second event will be something a little bit more formal, not too much so, but an opportunity to kind of have a chat with the team, and we may or may not do a short kind of presentation or panel style discussion that's still being locked in. But yeah, you can look forward to likely those 2 community events during the ETH Denver core days from 2nd to the 5th, I believe. Yeah, and then one more thing. Oh, yeah, that's right. So we have made some progress on our friends over at CoinMarketCap. So you may recall probably a few months ago now, I guess, some of the token supply details were updated to be more accurate on CoinGecko. We're going through that same process with CoinMarketCap now, correcting some outdated info, hooking up some APIs. We just want to verify that that's all correct, and then we'll reach out again to the CMT guys to get them to verify that, and then all going well, it should reflect our correct market cap ranking and the like on CoinMarketCap. So that's good to see. I think that's all the updates I have. But we've got a chit chat on in a couple of days. So feel free to join in the Discord. And I think, as you said, Jasper, and as always, we've got recording available on YouTube probably later today in a few hours. If you're listening to this, on Twitter, you probably don't need to check out that recording. But for anyone else, yeah, the Twitter Spaces are always available up there. So that's all from me, and we'll chat in a couple of days, I guess.
Yeah, great, awesome. Thank you for the updates. Those ETH Denver events sound pretty fun. Wish I could be there.
We'll send you lots of photos, don't worry.
Awesome, perfect. All right, thanks everyone for listening in. Cheers.
See ya.
Thank you. Bye.